Hello and welcome. At our last web chat on AI, we were talking about the general use of the technology, and now we're going to be talking about a specific use of AI. Again, we have Igor Zaks, President and CEO of TenzorAI, who has many years' experience in various financial roles, including credit risk for corporates and banks, who's going to explain how AI can be used to manage credit risk. But can you go a little bit more in detail in terms of the types of credit risk and why it's a problem?
Sure. And the important thing is what asset we are looking at, and the asset is receivable. Now, receivable is a very different creature from, for example, bond or bill of exchange, because the other instruments are pure credit risk. So you just take this instrument and it is risk of the counterpart. In the receivable world, risk are mixed. So you have credit risk, you have performance risk. Maybe you didn't perform the contract. You have dilutions, you have delays. So you have fraud. You have a lot of different factors affecting the payment. And sometimes they're mixed. Sometimes you think it's a delay because of a dispute. In fact, it's a pre-default or anything like it. So, and that's why the complexity is common, that it's very difficult to understand exactly what type of risk you are dealing at each point of time.
So what we've got is different levels of modeling required. Can you explain these three different types and why you need them?
Oh, absolutely. So when you manage the risk, you have three principal different tasks. So one is that what your credit manager is doing day to day. So you get counterpart, you get a new customer, existing customer. You need to assign the limit to them. You need to understand also how risky is this customer. You probably also want to understand what may be dilutions, what may be delays. So you really need to understand this specific transaction with this customer, what relates to it. Your second level is what treasurer, what CFO will be looking, and you really need to understand how is your portfolio performing. Do you make adequate provisions? What's going to happen in different assumptions? How things are interrelated? So your portfolio may be diversified as you think, but you suddenly find everything moving together. So you really need to understand what's going on portfolio. And the third part you need to model is what's going to happen with financing. Because you can use all the different type of finance. You can use credit insurance for your portfolio. You can fund yourself through asset-based lending. You can do a securitization transaction. You can do factoring. Each of these transactions would have their own parameters. So you get different features. I don't know, aggregate first loss, for example, over collateralization, various support structures, some contingent liabilities. So what you need to do is to understand what's going to happen when your portfolio will perform as it should. So you get some default, you get other things that you model, how it will affect the finance and what's going to happen. So you need to look at all these three levels to get a comprehensive picture.
Within credit risk, what's the model that's really needed?
To deal with both the information that is external, that everybody is doing, so you are getting, say, financial things like it, but you also need to look at a lot of internal information that you have. Because effectively, companies are sitting on a gold mine of internal information, particularly if it's a relationship business. If you deal with the same customers for, I don't know, 10 years, you really have a lot, and you need to have use of it. You can move to the next slide. That basically is the way how we look at this. So, I mean, if you look at performance of the companies and you look at a very good credit manager, he is sort of doing it in his intuition. He will look at what's happened with this customer. He will talk with the sales team. He will get a lot of information there. And that's why a lot of credit managers have a very good performance, much better than external finances. But there is no regular data-driven process to do it. And that's exactly the thing we're addressing. So what we are having here, we are going into the systems that company has. So the two key systems that company has are ERP and CRM. So ERP is basically a system of record. So that's where you know everything that did happen. And that have financial information and non-financial. So you know, for example, that customer was paying late, but you also know, for example, they were buying particular product. And you know that the previous people who stock a lot of this product get into trouble. So you have a lot of information you can dig from it. Then the CRM is also useful in a different way, because CRM is basically showing you what people are talking about, what are their pipelines, what are the things for. And again, you can match it and you can see with this. So if you are a relatively large player in the industry, you will get a lot of this information. So what we do, we analyze all this information from the systems. We combine it then with financial information, with external reports and everything else. And as a result, we can come with predictions for particular individual customers. So we understand both their credit risk, so we see how likely they are to default and what will be the expected recovery. But we also looking at how likely are they to pay late, what is the likelihood of dilution and things like it. We then look at the same thing on portfolio level. We can also make a model of the various changes in the credit assessment and how it will be. And we can also go to modeling of financing programs. Now, what we can do with this data, we do two things. We give it back to the company, so the company can use it in the decision making at all different levels. And at the same time, if needed, this can be shared with financial institutions who have no clue about all these different things. So their risk appetite, their pricing, their approach is based on the fact they don't have this visibility. So very often what we can see, if we improve the visibility and we allow these tools to be used by both company and financer, you can have a significantly more robust financing structure.
So your model is your TenzorAI engine is both a data collector and a aggregator, and then making predictions from it that go both to the supplier and also to the financial institution.
Yes.
How is it received by the supplier, and then how is it received by the financial institution? Do they like it?
So far, we get a lot of positive feedback.
What does that mean?
Yeah, people like it.
And do they use the results? Do they incorporate them in decisions, financing decisions?
At this point, we are at the pilot stage, so we don't have the tools running as part of a regular process yet. We hope to have it soon.
This is actually a good time for us, because you're in the sort of the proving stage, to have a look at the demo. First, what are we looking at?
As we mentioned, we have 3 levels of management, and we will show on this demo 2 of them. So the one we are seeing now is how do you make individual credit decisions, and what is the model outcome. So let me pick up a company out of your list, the ones that you want to look at this particular point of time. So I pick in a company here. And what I then do, I'm showing what type of limit I want to get for this company. What will be my credit terms? So let's put it, say, 45 days. What I can then do, I can show what will be the level of risk tolerance that I want to do. So what I can say, I can separate my customers. I can say there are customers that I want to have more risk tolerance or less risk tolerance. So for example, the most important customers, people who are highly profitable, people who are strategic, I can set up a different policies that, for example, the ones that are not strategic. So I can manage my sort of overall risk aversion, but I will split it with different groups of customers. What it's producing me now, it's producing me what is the recommended limit. It's also producing me a number of calculations. So it's giving me a probability of default. It's given, so in this case, 0.26%. It's showing me loss given default. It's showing me how late will be my payment. So in this case, they are not very good. So they are 45-day terms that are already quite long, and they're 24 days expected delay. It's also shown what are my expected dilutions. So which part of the invoice is not going to be paid because there will be a credit note or other things not credit related. Then it's showing me what is the information being used. So here there are no audited financial, we don't have internal data of the buyer. So we have quite a limited information. We have to rely a lot on our trading experience, on what we know about this people. So we will have a lot of information coming from ERP data. So we saw what these guys are buying, we saw the patterns, we compare it with other things we know. We use some of the CRM data, we know what is their pipeline, what they're doing. We will also get the buyer's financials. In this case, they're not audited, but still we can analyze them, we can get whatever we can from it. And it will also be credit review insights. So people within a credit department talk to the customer, get some notes, get some extra information. We can read it using natural language processing. So we can actually read unstructured information from the file. It's also then shown what is risk factors. So if you take example of this customer, the geography is a big part. So these people are located in a territory that we consider to be a relatively high risk, and that's important thing. So what we do, when the model is making decisions, we are making this explainability. We are explaining what are the key things. Then we have things like seasonality. We have an industry. We have products. So we can have, for example, that they're buying something that we know there is a massive oversupply in the market, and they're quite likely to be stuck, for example, with excess inventory. So we can go all these factors, and based on these factors, we recommend the limit and we explain what actually going to happen on this customer. The second screen is a portfolio model. The first is individual customer. So this is the first level of model, and we are looking at the risk of one customer. Now we are looking at a risk of overall portfolio. We are seeing what are our exposures. So, and let's select a sub-portfolio. So for example, I only want to look at my sales in Europe, Middle East, and Africa. And I want to look only at office suppliers and only on cables and connectors. So I'm not interested in the software sales. I'm only interested in this particular sales. So I basically, by clicking these buttons, I selected part of portfolio. This is the one I'm interested in. That can be aligned to a business unit, can be aligned to financing program. This is my way to select what part of the business I want to look at. What it produces for me, it produces for me several things. It produces for me expected loss. So what is my likely losses on this portfolio? So that's, and that will be in the currency units, and it will also be in percentages. It will also show me what is my average delay. So it's shown in average, I will be 3.9 days late. And if you look just under average delay, you have weighted average terms. So my terms, that is just a pure simple arithmetic calculation, my average terms on a portfolio is 31 days. What I know out of my model, I'm not going to be paid in average in 31 days. I will be paid in 34.9 because 3.9 will be average delay. It's also showing me total overdue, total outstanding. If you look at the right-hand side, you have two things that are very useful in terms of understanding portfolio. So the one at the top is a heat map. So what we are seeing here, we see top customers. So it can be top 50, top 100 customers. If you go for a particular customer, the size of the square will be actual expected loss. So expected loss is obviously my exposure multiplied by probability of default and then y minus recovery. The color is actual probability of default. So some people with expected loss maybe because the exposure is high, some because the customers are quite risky. So it's a combination of three factors. So what we see, this is something that should be in front of the treasurer, in front of the top management all the time. This is the answer, what are my risks in my portfolio? The one under it is another thing that is very useful, because people do cash forecasting in all the different ways. We do it here ground up. We look at individual customers, we look at performance of each invoice, and we model it and convert it in what will be our collections by day. And any day that you put here, you can see what exactly invoices that's supposed to be paid this day, not in theory, but with our model. So if we are saying that particular invoice is likely to be delayed, we are booking it to the day when we expect it to be paid. So you can see the cash flow that is significantly more accurate than traditional because it's going ground up from individual customer information. And you also can see the risks. So for example, if you have a payment that you need to do and you have, say, 7 days grace period, you can look what is the likelihood you are not going to collect enough cash during this particular week. And then there are two stress testings. One is what is the likelihood that loss will exceed certain level. So our expected loss was 6.5K. Let's put it, say, to 50K. We are saying, I'm okay having some loss, but if it's going above 50K, that's a problem for me. That may be related to provision, that may be related to a financing structure. For example, you have aggregate first loss, you're seeing how likely you are to breach it, or maximum liability. And in this case, it's saying it's 4.6% probability. And the same thing you can do on delay. So you're saying, my expected delay was 3 days. How likely is it to be delayed by 10 days? 17%. So you can see both of these stress tested.
So who is the user of this? Who do you expect to be using this?
First screen is mainly for the credit manager. If it is a credit decision by financer, they can also use the screen to make that decision on individual exposure. For example, credit insurer might use it for the limits if this is the way they work with, but the main user is the credit manager. The main user and also the top management. This is shown performance of portfolio. So credit manager can have it and it's useful for him, but the main users will be treasurer, CFO.
How would you sum up what you're doing here?
We are building bridges. We are building bridges inside the company. So we are making sure that the credit process is integrated in the company and can be efficient to use between the credit function, treasury, CFO, so that we can actually have the information coming into one source and getting a data-driven decision. We're building another bridge that is a bridge between the companies and finances. So we are looking there and we're trying to avoid the situations that we see too often when the company is saying, yeah, we are dealing with these people, we're very comfortable with exposure, we dealt for 20 years, and financial institutions saying, oh no, we look at their balance sheets, this doesn't really make sense. So we're trying to make sure we are able to get the best information available from the source, use the right tools to work on it, and therefore provide the right picture to the right people.
Thank you, Igor. That is a good illustration of how AI is working beyond the solutions that we're seeing in some parts of payments and other things. Thank you. Most interesting.
Thank you.